You came to Canada to build a better life. And every month, a portion of that better life leaves your bank account and lands in someone else's country. I'm not saying that is wrong. I'm saying most people doing it have never once sat down and calculated the total number. The full amount. Every transfer, every year since they arrived. Not the individual transfer. The cumulative total. Because the individual transfer always feels reasonable. $300, $500, $1,000 when something happens back home. Reasonable. Added up across 10 years. Then calculate what that number would be worth today if it had gone into your TFSA instead. That number will make you uncomfortable. This video is about that number, and about something more important than stopping the transfer. It is about changing what the transfer is actually for. Let me put a real number in the room. According to World Bank data, Canada is among the top 10 remittance sending countries in the world. The Filipino, Indian, Nigerian, and Ghanaian communities in Canada represent some of the highest per household sending volumes among all immigrant groups. Estimates based on Statistics Canada household data suggest that remittance active households in these communities send between $5,000 and $15,000 Canadian dollars per year, depending on income level and years in Canada. I want to use the conservative number, $5,000 per year. At $5,000 per year for 10 years, that is $50,000 that left Canada. Now here is what $50,000 looks like inside a TFSA invested in a broad market index ETF at the historical average Canadian return of approximately 7% annually over 10 years. The answer is approximately $70,000. Tax-free, with zero additional effort beyond the initial decision. The gap between $50,000 sent home and $70,000 grown in a Canadian registered account is $20,000. In 10 years, on the conservative sending estimate, before fees. That is the number nobody in this conversation names out loud. I'm naming it, not to produce guilt, to produce a decision. 3 pieces of evidence. Each one adds a layer to the cost. The first layer is the fee structure. And this one most people in my audience have never fully priced. When you send money home through a major Canadian bank, the advertised fee is rarely the full cost. There is the sending fee on the Canadian side. There is the exchange rate markup, which is not called a fee, but functions as one. And then, in many destination countries, the receiving institution charges a withdrawal fee when your family accesses the funds. The World Bank's remittance prices database shows that sending through major Canadian banks typically costs between 3 and 6% of the transaction value when you include the exchange rate spread. On a $1,000 transfer, that is $30 to $60 leaving before the money even arrives. And if the person receiving it pays an ATM, our bank withdrawal fee of 1 to 2% on their end, the true round-trip cost of that $1,000 is closer to 4 to 8%. On $5,000 sent annually, at a blended round-trip cost of 5%, you are losing $250 per year to fees alone. Over 10 years, that is $2,500 paid to institutions that added no value to your family relationship whatsoever. The second layer is the RRSP employer match that most people in this audience are systematically underusing. According to Canadian HR research, between 30 and 40% of midsize and large Canadian employers offer some form of RRSP matching. A standard match of 50 cents on the dollar up to a defined cap means that for every $2 you contribute to your group RRSP, your employer adds $1. That is a 50% guaranteed return before your investment earns a single percent. There is no savings account in the Philippines, Nigeria, India, or Ghana that offers a 50% guaranteed return. If you are sending money home while leaving employer RRSP matching on the table, you are choosing a lower return vehicle over a higher return vehicle. That is not a cultural decision. That is a math decision. The third layer is the tax refund most people are not collecting. An RRSP contribution generates a tax deduction. For a person earning $80,000 annually in Manitoba, the marginal tax rate is approximately 33%. A $10,000 RRSP contribution returns approximately $3,300 from Sierra the following spring as a tax refund. That $3,300 is money the Canadian government returns to you for participating in your own retirement savings. It is not complicated. It is not a loophole. It is the system working exactly as designed. And it is available to every person in my audience who files a Canadian tax return. I sent money home. For years. Not because someone forced me. Because it felt like the right expression of what immigration was supposed to mean. You go. You succeed. You send back. That is the script most of us were handed before we got on the plane. But I spent 2 decades crossing 4 continents, working in oil and gas, in aerospace, sitting across tables from people from 30 countries who were all at various stages of the same realization. The realization that sustained financial transfer to people who have not built their own financial capability is not generosity. It is dependency creation. There is a principle I came to believe deeply, and it is not a financial principle first. It is a human one. You do not give people fish. You give them the hook, the line, and the knowledge of where the water is. When I looked honestly at my remittance pattern, I had to ask myself one question. Was the money I was sending building anything? Was it funding a business, an education, a property, a retirement plan for the people receiving it? Or was it covering a monthly gap that would reopen the moment the transfer stopped? For some of it, the honest answer was the second one. So I changed the structure, not the relationship. I reduced the recurring transfer as my Canadian portfolio grew and performed. When my non-registered accounts here in North America were producing real returns, sending money abroad to earn a lower yield on someone else's behalf stopped making mathematical sense. I kept the strategic transfers, the ones tied to a conversion opportunity when the dollar was strong, the ones building toward something specific back home. I cut the habitual ones, the ones that were fish, not hooks. And here is what I noticed. The relationships did not break. What broke was the expectation of a transfer. Those are not the same thing. That distinction changed how I think about the money and about what I owe the people I came from. 3 moves. Specific to the Canadian system. Each one changes the structure of the remittance decision without requiring you to end the relationship it is connected to. The first move is the cumulative cost calculation. You have never done this. Almost nobody has. And until you do it, every individual transfer will continue to feel reasonable because you are evaluating it individually instead of cumulatively. Here is how you run it. Go back through your bank statements or transfer records for the last 3 to 5 years. Add up every international transfer you made. Everyone. The regular monthly amount, the emergency transfers, the holiday contributions, the family crisis responses. Add them all. That is your cumulative outflow number. Now take that same total and run it through a compound interest calculator at 7% annual return, invested progressively over the same period inside a TFSA. The gap between those two numbers is your opportunity cost, not a projected number, a real one based on your actual behavior. Write it down. Keep it somewhere visible. That number is not a guilt instrument. It is a baseline. Every future transfer decision happens with that baseline in view. The second move is the fee elimination audit. Whatever you decide about how much to send, you should not be paying bank rates to send it. Canada's financial intelligence regulator is called FINTRAC, the Financial Transactions and Reports Analysis Centre of Canada. Any institution moving money internationally on behalf of Canadian residents is required to be registered with FINTRAC. That registration is the compliance floor. It is the minimum standard. It is not a premium. It is a requirement. FINTRAC registered digital transfer providers currently charge between 0.5 and 1.5% for international transfers to major remittance corridors, including the Philippines, India, Nigeria, and Ghana. Your Canadian bank is charging 3 to 6% for the same transfer. The fee elimination audit takes 1 afternoon. You identify your current provider, you look up their all-in cost including the exchange rate spread and any receiving fees at the destination end, and you compare it to 2 or 3 FINTRAC registered alternatives. If your current provider cannot demonstrate that their all-in cost including the exchange rate margin is below 2%, you move. Here is the sentence to use when evaluating any transfer provider. What is your all-in cost including the exchange rate spread for sending 1,000 Canadian dollars to the Philippines, or whichever country applies, And is your institution registered with FinTrack? If they cannot answer both questions clearly, that is your answer. The third move is the dependency audit. This is the hardest one. And it is the one that determines whether the first two moves actually change your financial trajectory or just reduce the cost of the same behavior. For every person or situation you are currently sending money to, ask one question. Is this transfer building financial capacity on the receiving end, or is it covering a gap that will reopen the moment I stop? Transfers that build capacity look like funding a sibling's education, contributing to a parent's retirement plan or property, investing in a family business with a defined return structure, or building a cash reserve toward a specific goal on a defined timeline. Transfers that fill gaps look like covering regular monthly shortfalls, paying recurring household expenses indefinitely, funding lifestyle consumption without a defined endpoint. The dependency audit does not tell you to stop sending money. It tells you to restructure what the money does when it arrives. That restructuring is the difference between being financially generous and being financially responsible to the people you care about. A practical way to implement this: for any regular transfer you currently make, attach a one-sentence purpose statement to it. This transfer funds my mother's medical insurance premium. This transfer contributes to my sister's education savings. This transfer covers my parents' monthly food budget indefinitely. The third category is the one to examine, not to end it immediately. To ask whether the people receiving it could, over a defined period, build the capacity to cover it themselves. And whether part of your responsibility to them is to help them build that capacity rather than simply filling the gap each month. That is not a cold calculation. That is the most respectful financial position you can take toward the people you came from. The money you send home is not the problem. The problem is sending it without calculating what it costs, without minimizing what it loses to fees, and without asking whether it is building anything on the other end. 3 moves. The cumulative cost calculation, so you are deciding with real numbers instead of individual transaction logic. The fee elimination audit, so the institutions processing your transfers stop taking money that belongs to your family. And the dependency audit, so the transfers you continue making are building something, rather than simply maintaining a gap. Subscribe if this names something you already felt but had not seen calculated. The next video covers the FHSA, the first home savings account, the newest and most underused registered account in the Canadian financial system, and why it is specifically relevant for multicultural Canadians who are still deciding whether Canada is where they stay. You did not come here to send money. You came here to build it.